Right. So this is the third video, sort of ending financial performance. So this is part three. So we've talked so far about profitability and we've talked about liquidity, and now we're finally talking about risk. So 3 or 4 short slides, and we'll talk about some shortcomings, consequences, that sort of thing. So measuring risk. I mean, fundamentally, this business wants to remain a going concern. So, I mean, like anything in life, you don't want to borrow too much, take out too many loans, and not be able to meet your liabilities, your interest payments, and therefore suddenly have to forfeit your business. So most people, most lenders, of course, would want to know what your gearing is like, if you like. And really, when we talk about your gearing, just really what is the risk of default, so to speak, or what is the risk of crashing? And I kind of always talk about it in terms of if you think of the gears of a car as well. So the higher your gearing, if you like, the closer you are. Imagine you're on 5 or 6, and you're which is really high, where you're in effect your debt over equity, the relationship between the amount of money you owe and the amount of equity that you have in the organization is higher. Then there's the risk. You think of it as you're speeding if you like, where they're sort of, and if the economy suddenly takes a turn, or you have a tricky road to maneuver, you're more likely to crash. And so that's where I believe the term of gearing comes from, or just the idea of setting, if you like, a process into place or into action. So typically, we're talking really now about long-term debt as a percentage of equity. I've always preferred debt over equity because really you get a straightforward comparison between the amount of debt and the amount of equity. I guess the point is if you decide to go for this option, debt over equity, or to go for debt over debt plus equity, which is really looking at the amount of debt against what is being used to run this company. So for example, A is equal to C plus L. In effect, C is E and L, of course, is debt. So we're really saying that overall, how much debt do you have as a percentage of the total amount of money that's been borrowed? Because, right, all of this has been borrowed, if you like, come into the bank, and then you've used the money here to then buy whatever assets it is that you need. So really, it doesn't matter as long as you use the same ratio for the previous year and the coming year to sort of compare. So a high level of gearing. Again, of course, we must look at the industry, because sometimes the question is, should we go with debt or should we go with equity? The truth is that debts can be cheap depending on where you are. I mean, now in England, with the fact that I think we've been told that interest rates will remain static at least for the next 3 years. There will be no change there, and interest rates are low enough. So, to some extent, you could consider debt to be cheap in that regard. As opposed to equity, where you give up control of your business, isn't it? You still have full control with debt, or more control at least. So, high level of gearing indicates that the company relies heavily on debt to finance its long-term needs. This increases the level of risk for the business, since interest and capital payments must be made on debt, whereas there is no obligation to pay on equity. So I guess the question really here is, if you have debt over equity, what you could do to improve things would be to, of course, reduce the amount of debt and thus reduce the amount of interest you have. The other test of looking at this, like I said, is how able are you to meet your finance costs. Right, and ultimately you meet your finance costs out of operating profit. So this is really a simple, straightforward interest cover. How many times does your operating profit cover your finance costs? So if you like, a fall in your interest cover means that you are less likely to cover your finance costs compared to where you had, well, again, if your profit covers your interest covers over so many times, and that's a wonderful thing. That's then you are kind of doing well. Key point is, it doesn't really matter what the finance costs are. Your operating profits are much higher. Or it might be the case that you don't have that many finance costs, which is brilliant. So in terms of improving this ratio, for example, it is either increase your operating costs or reduce your finance costs, if you like. Right. And last one, of course, is to do with dividends. I guess this is I would call it an investment ratio, but it's also a risk ratio to a certain extent. The same thing, dividend cover. How many times over can your net profits cover your dividend, if you like? And so really, a decrease in the dividend cover again indicates that the company might be facing the risk of not being able to make its dividend payments, if you like. So this is on the assumption that you make regular dividend payments every year. So really, this ratio would work that way, and just really how often, basically how many times your net profit covers your whatever dividend it is you're giving that year. Right, and there we are. So just looking at some of the issues that we tend to find with this, because I think this is the kind of thing you can get asked maybe to discuss a little bit of this. The problem with these ratios, if you like, fundamentally with these financial performance ratios, which is why in the next section where we look at non-financial performance indicators, we will see why those matter, is this issue of short-termism, if you like. So the fact is, because you have this kind of year-on-year approach to looking at things, there is an issue here because people are very much interested on short-term financial performance, and they'll be doing anything they can to get their bonuses and to look good in that year. So again, they may decide to cut investments or to purchase cheaper or poorer quality materials because you're trying to make all your profitability ratios look good. So trying to reduce your costs, increase your revenue, all that sort of thing. So in order to achieve this target financial performance, they may be tempted to manipulate results. So what does that mean? You could accelerate revenue. So start recognizing revenue early in the year when you shouldn't. Delay costs, if you like, just to improve performance. So you've had the cost, but you don't recognize them in the correct year. Understating provisions and accruals, yeah, because these are expenses, or just manipulation of accounting policies. So making sure accounting policies make your expenses favorable for you, or your losses, or your revaluations higher, whatever it is. The key point is that you can manipulate those. And the other thing about these short-term financial performance indicators is that they don't convey the full picture that really drives long-term profitability. So customer satisfaction, quality, internal processes, how people are actually doing within the organization in terms of personal growth, and that sort of thing. So really, we will look in the next section, in the next video, we will look at some of those other things. If you really want the company, from a management accounting point of view, remember, we're not reporting now. We're really looking at how do we make decisions that will improve profitability, which is what we're trying to do, as opposed to just for the sake of it, just calculate these ratios. No, we're trying to improve the ratios, so we need to look at what's behind the ratios, and we'll do that in the next section. So yeah, and that brings us towards the end. There is a question, please, I would like you to do. I mean, this is all practice, like anything. Definitely, it is. Yeah, there's this question here, please. I mean, it's a practice question. I think it's a good question to get yourself into. Looking at these ratios now. This additional example, please work with this question. It's on page 437. So please have a go and just enjoy the question. It's not a bad question at all. And for yourself, see if you can write out some good summaries on the ratio analysis. Awesome. See you in the next video.